Hello, everyone, and welcome to today's webinar, Upset and Reset, Association Affiliations and Mergers. Before we get started, I would like to go over a few items so you know how to participate in today's event. You have joined the presentation listening using your computer speaker system by default. If you would prefer to join over the telephone, just select phone in the audio pane and the dial-in information will be displayed. All attendees are in listen-only mode. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time throughout the presentation. We will collect them and address them during each presentation. Today's webinar is being recorded. The information contained in this presentation is provided for general information purposes only and is not intended to serve as legal advice. A copy of the audio recording and slide deck will be emailed to you within 48 hours of the completion of this live presentation. You will also receive a short survey upon the completion of this live webinar. Please take a moment to respond to the questions so we can continue to serve your needs moving forward. That being said, I would now like to pass the presentation over to Kelly and Marie. Kelly and Marie, please go ahead.
Good afternoon. I'm Kelly Newton, and I'm a partner at the law firm of Whiteford, Taylor & Preston. Whiteford is a full-service firm with over 175 attorneys. I myself have over 30 years of experience representing corporations, including tax-exempt associations and other nonprofits in all aspects of their business. Whiteford's associations, nonprofits, and political organizations practice, of which I am a member, represents several hundred local, regional, national, international, and global nonprofit organizations and associations, certification and accreditation bodies, and charitable foundations.
And hi, everyone. My name is Marie Caputo. I'm a principal with Clifton Larson Allen. And at CLA, we are a professional services firm providing the traditional CPA services as well as outsourcing advisory and wealth advisory services. And I've been working with nonprofit organizations, tax-exempt organizations for over 28 years. And at CLA and on our DC marketplace, we work with more nonprofit organizations than any other accounting firm in the country, over 7,000 across the US and world. And in the association and membership organization world, we work with more than 2,000 association and membership organizations. Very happy to be here today to talk about this topic and share this conversation with you, Kelly, and everyone on the phone. All right. Oh, go ahead, Kelly.
Oh, sorry. We realize that several associations may be considering combining one way or another with another association due to the economic realities brought about by the pandemic. Although there are many ways that two associations may combine, today we're going to explore two of them, which is an affiliation and a merger.
And then looking to what we have on the screen, we're going to launch a polling question. So for our first polling question today, we want to know a little bit about what you at your organization is experiencing. So what brought you to today's conversation? Are you experiencing a decline in your membership or your revenues? Are you looking to have a different geographical footprint than you currently have today? Perhaps have an impact on expansion or enhancement of programming or changes in there? Or is it a matter of competition for resources and members? Please answer the poll, and we're going to go ahead and close that out. I'm curious to see what those results are. Kelly?
Looks like, the one that received the most votes is a desire to expand and enhance programming, which is one thing we're certainly hearing from our clients. And that may or may not be because of the pandemic. And then competition for members and resources and decline in members and our revenue, which is certainly tied, is next. And third one is to desire to expand geographical footprints. Well, all four of those are what we're actually hearing from our clients, both of our clients, as to why they may be considering a merger. I'd like to point out one other issue, and this is the next slide, please. there are many considerations as to whether an association may want to merge. There are certainly several that we're not going to be discussing here today, but I just want to point out 3 of them that are very important. And they are, would an association be able to accomplish more combining with another association than as a separate organization? One that's really important is about the 2 cultures of the organizations. Will they be able to combine to make a successful merger? Then, of course, there's all the other practical considerations, such as similarities in membership categories and programming.
And I think we're going to the next polling question. Of the types of changes we're going to be talking about today, and affiliation is one of those. And we're curious as we launch into this topic whether or not your organization has considered an affiliation as a type of merger or change in structure, such as a change in your parent subsidiary relationships. If you could just click on yes or no there as we close out this polling question. Curious to see what this response is. Okay, so some of you are considering it, some of you haven't considered it. And as we go to the next slide, you know, again, as we're thinking of that affiliation or change in affiliation, we're thinking about when one organization is becoming the subsidiary of another existing entity by giving that other entity reserved powers over its conduct, and by entering into some form or fashion of cost-sharing agreements or memorandums of understanding as to how they're going to work together, share resources and costs, and then potentially change that structure or reporting between those entities. So I'm going to talk a little bit about the accounting ramifications of this first on the next slide. And then Kelly's going to pick us up and walk us through some of those legal considerations. From an accounting perspective, this is the easiest of the accounting transactions to watch out for. And really, as we look at it from an accounting perspective, we're thinking about how has this change in relationship impacted the reporting entity. So when we look at a financial statement of an organization, we're looking at a subsidiary standalone or a whole reporting entity, which may include a consolidated group. So as we're looking at that affiliation, and I think that must be me. As we're looking at an affiliate from an accounting perspective, we're looking at a party that directly or indirectly through one or more intermediaries controls or is controlled by or is under common control with an entity. So you get the theme here from an accounting perspective. We're very interested in understanding where control rests or lives, as well as economic interest in determining whether or not you're required to bring entities together when you report in their financial statements or to provide that consolidated financial statement. So we look at it as a requirement. Must you do it? Or are you permitted to combine the financial information in a combined financial statement of multiple entities? And under our slide here, starting at the top, you are generally going to be required to consolidate if there is a sole corporate membership. So generally that is going to indicate that control exists between those entities, and consolidation will be required from a financial statement and reporting entity perspective. We also do look for instances where there may not be a sole corporate membership, but perhaps there's another trigger within the bylaws or other aspects of the organizing documents that does create a majority voting interest by one entity on the board or governing body of another. So oftentimes we see that in the bylaws, and the controlling entity is in a position of appointing the majority of the board members of another entity. And again, from an accounting perspective, when those situations do occur, consolidation is required. It's important to know that going into it because it does impact how you are going to present your financial statements, the collaboration that may need to go into that process at year end, and also other impacts such as timing. And when you think of the reasons why you present financial statements at year end, you're going to be thinking of requirements of your stakeholders, requirements of funders outside of the typical membership fee arrangements, and any requirements that you may already have in your organizing documents as well. Now, when we look at a situation where either control or economic interest exists, but not both, then you're not required to consolidate. You're not permitted to consolidate, but you may create a combined financial statement. So as you look at other instances where control may be through a contractual arrangement or an affiliation agreement, you're not allowed to consolidate again, but again, you are committed to create that combined financial statement. So thinking of a large group of affiliated entities within the association world that may have a national as well as more local geographical associations or chapters or more grassroots focused entities. In that instance, generally, you're not going to have both control and economic interest, but you would be allowed through those affiliation arrangements that you have to do a combined financial statements if that is of value or interest to the organization. So again, the easiest from an accounting perspective, and that primary consideration is what does that new reporting entity look like? Kelly?
Next slide, please. Thank you. From a legal perspective with an affiliation, both entities remain intact. So neither of them disappear. But what is going to change is the governance of what now becomes, let's call it the subsidiary. And in any legal transaction, the steps are different from organization to organization or deal or transaction to transaction. So what I'm going to give you here are the general steps that would be taken in an affiliation. Of course, if this is something that you are considering with your organization, and it's going to, what actually has to happen is going to depend on your governance documents and the state statute that governs your organization, and other practical considerations such as programming and other things that I mentioned above. So the most important thing in any transaction between an association and another entity is a non-disclosure agreement. Or that's the initial important document. And that's something that should be put in place as soon as discussions with another organization take place, even if they are discussions that are really at very high level and maybe aren't serious. This will ensure that each party is going to maintain the confidentiality of the other party's documents. And so that you're really confident that the nature of your conversations will be held in confidence. It also is important in an affiliation, not necessarily as important as a merger, that there's going to be some documents that are going to be exchanged, such as financial documents and maybe licensing documents, and all of those documents you want to remain in confidence and confidential. Sometimes with an affiliation of this nature, there's either a memorandum of understanding, an MOU, or a non-binding letter of intent. Those documents might be used to put the thoughts as they progress down on paper, and at the end, you'll have an understanding with the other party as to exactly what's going to happen. You don't necessarily need that, but that really becomes important when it comes time to file the documents that may be necessary, which will include at least changes in bylaws. The MOU, as I said, will discuss also the powers that will be given to the new parent. As Marie said, in this type of affiliation, the parent is going to have some reserved powers over the subsidiary. So what this means is if the subsidiary wants to take a certain action, and if its governing documents say that the parent has the right to either speak to that change or actually make the decision as to that change, that's called a reserved power. So you'd want to talk about that up front. What type of reserved powers will there be? There's often some that are pretty obvious. It's you know, the subsidiary can't dissolve or liquidate or sell a bunch of its assets or acquire a bunch of expensive assets. Those are pretty typical. There might also be a certain level for expenditures, and perhaps there is going to be a requirement that the parent participate or at least have the right to refuse any high-level changes, personnel changes that might be made in the subsidiary. Those are the type of things that would be in the MOU. Also, new programming. The subsidiary may want to enter into a new line of programming, and it may have to get the consent of the parent. That's, again, what the parent's ability or requirement to say yes or no is what's called a reserved power. So also in the MOU, you would likely discuss who's going to be on the boards. Generally, it's just the subsidiary board that's going to change, and that may mean that some of the board members from the parent are also going to be sitting on the subsidiary board, or if the boards want to remain more independent, which is there's a lot of reasons to do that, maybe the board just appoints new member, or the parent just appoints members of the board of the subsidiary. The MOU would also discuss timing. When do you want this to happen? What are the steps that need to be taken in order to get to this point? And announcements to memberships or others, and also costs that will be shared. And we'll talk about that in a little bit. In any situation, any combination, any transaction, you always have to take a really hard look at your governance documents. And you also have to look at the state law under which you operate, because there may be something in your state statute, your state formation statute, it's also called the governing statute, and you all have one, that may trigger some kind of requirement for this type of affiliation. But you at least have to take a look at your articles of incorporations and your bylaws to see what steps must be taken in order for an affiliation to take place. This, as I mentioned earlier, this is going to require at least an amendment of the bylaws for the subsidiary, because it will now have to say, you know, subsidiary may not take certain actions unless parent says ABC. You also will look at the governance documents to see whether the boards have to approve, which they most likely will. Also, would your members have to approve this type of affiliation? That should be spelled out in your documents, in your governance documents, and if it's silent, then you need to look to the state statute. In this type of affiliation, it's unlikely that any state requirements, any state filings will be required. Again, this isn't an acquisition where one entity is going to eventually dissolve. It's also not a merger where a plan of merger is required. But again, you'll have to look at your state statute to make sure that's the case. Now, another thing that's really important when you start considering a transaction with another entity, an association, for instance, is whether your entity is in good standing. You should look at that right at the beginning, because that would be something that may hold up actually the closing of this affiliation. So for example, if you're a DC nonprofit and you fail to file your 2-year reports for 3 times in a row, you've probably lost your status as a nonprofit corporation in the District of Columbia. So you want to make sure you're in a good standing before you start any of these conversations. That's also just a very good thing to check on once in a while. Also, because of what I've mentioned before, you're going to need to schedule sometimes in advance and obtain the consents of the board and members. And that's generally not an issue with your governing boards, because it's generally easy to call a board meeting. The board members, you have fewer board members. Sometimes associations have monthly board meetings. Generally, there's a provision in the bylaws of the state statute that permits you to have those board meetings via telephone. So it's generally easy to get the board members together. What may not be so easy is getting a membership meeting together if the members have to agree to this type of affiliation. Often associations have one membership meeting a year. It's required by almost every state. And if you have many members, sometimes thousands or hundreds, it may be really difficult to get that membership together. So again, you could always call a special meeting. Maybe there's an opportunity to vote via ballot or in another mechanism by proxy, but you really need to give that some thought. For instance, if you your only annual meeting of the members is coming up, you want to really move pretty quickly so that you can throw this into the discussion at the members meeting. The next thing, and one of the major reasons that anybody would enter into an affiliation, is cost sharing. I mean, cost sharing, and we saw in the poll question that revenue is an issue, and that's an issue in good times or bad times, because you always want more revenue for more programming. So often there's a cost sharing agreement between the parent and affiliation and the subsidiary, and that needs to be at arm's length, and it would perhaps discuss costs of shared employees. Maybe there is an employee at the parent who can provide some services to the subsidiary. And you need to talk about that in the cost sharing agreement. How will those costs be allocated? Will that employee need to keep timesheets, which I always recommend is a very, very good thing to do. Also, other shared services, maybe in the mail room, maybe shared licenses, not only with the ability to use each other's trademarks, but also licenses you may have for computer arrangements. There may be not any need for the two subsidiaries to both have the same license agreements with certain kinds of software providers. But that's something that should all be discussed in a cost sharing agreement. And you would put that in writing, and that's something that you would sign at closing. And then this step, even though an affiliation is not a change in entity, there is a question on Form 990, Part 6, Question 4, which asks whether the organization made any significant changes to its governing documents since the prior Form 990 was filed. And you have to answer that question and consider exactly what's happened, but I suspect, at least for the subsidiary, the answer is going to be yes to that question. And if you answer yes to that question in Schedule O, you need to describe the circumstances, process, or changes that relate to the change in the governing document. Marie? Next
we
question.
have a question that popped up, Kelly, asking about the definition of an affiliation. And I'm going to share what that accounting definition was here on the slide. From the Financial Accounting Standards Board, for accounting purposes, an affiliate is defined as a party that directly or indirectly through one or more intermediaries is controlled or controls or is under common control with another entity. And I think the definition as you talked through it from your perspective, Kelly, was similar, but any differences that you would highlight?
Well, an affiliation in the legal world means many different things. And that's one thing you would have to actually, when you start, for instance, in your MOU, when you say we're going to discuss or in your NDA, we're going to discuss an affiliation, you just should describe what that means. For legal purposes, an affiliate often means a subsidiary, but it could mean something else. It could mean a sister company or a parent company is an affiliate of the subsidiaries. So that definition could mean a lot of things in the legal world. So you need to define it when you start talking about this relationship.
Yep, and in accounting, we're a little bit more narrowly focused on who holds that control. So hopefully that answers that question. If anyone does have any additional questions as we're going throughout, please submit them. We're trying to monitor and answer as we go. So up for our next polling question, if we could get that launched. We want to talk a little bit about mergers, and we're curious to know whether or not your association is currently considering a merger with another association. If you could just click yes or no. And if we could see how we're responding to that. And close out that poll. All right, Kelly. Okay,
interesting. So 64% of you say no and 36% say yes. So 2/3 to 1/3 here. Maybe after this presentation, those numbers would change a little bit. But next slide, so I can describe what a merger is. First, I'll say that there are several ways to merge. So I'm going to talk about the easiest one here. And that's where one organization merges into another, and the second one is called their surviving entity. And when the merger takes effect, the first entity, which is the merged entity, no longer exists as a separate entity. Other types of mergers, there could be an organization that is newly organized and both companies merge into that one. But I'm going to talk about a much easier one today, which is just the merged entities merges into the surviving entity and the merged entity goes away. Next slide. A merger from a legal perspective is more complicated than an affiliation. As we discussed, at least from a legal perspective, an affiliation may involve some bylaws changes and certainly some operating changes, and certainly it will preceded by a lot of discussions. But a merger is actually a much more complicated transaction, but I don't want to suggest that it's always overly complicated. The complication is going to depend on the complexity of the two entities that are considering this merger, and also whether one state statute is involved or whether two state statutes are involved. But I have actually done mergers which involved, other than the state filings, one other document, and it didn't take a lot of time. So just like an affiliation, or as I said, any other transaction you may consider, there should be a non-disclosure agreement. And again, the reason for this is so that the parties can talk freely and that there's no concern that some of the documents that are going to be exchanged are going to be disclosed. And that's really important in a merger situation because the two entities will want to perform due diligence on each other. And many reasons for that. For the surviving entity is going to assume all of the liabilities and all of the assets of the merged entity. So of course it wants to know what those are. It's going to want to look at all those documents to determine whether it's the right transaction for them. What are they assuming, and what liabilities now will they have to pay? What debts will they assume? And there are many documents that might be reviewed. That's something that the parties agree to. You usually start out with a list. I know with our clients, we have a standard list. We modify it depending on the actual entities, but it will always include articles of incorporation and all the amendments, the current bylaws, policies and handbooks. And the surviving entity would be interested in current policies and handbooks of the merged entity if for no other reason it wants to see how the merged entity's employees have been treated, or what have they been held to? I mean, what kind of policies do they have in their handbook? They may want to bring on or bring over to the merged entities, or the surviving entity may want to keep all the employees from the merged entity. So it really needs to have a feel of what the employees' expectations are. Also, IRS and state determination letters are reviewed, any sales tax certification, property exemptions, of course, list of members, and a list of members of the people on the governing board, the board members, for instance, and who the officers are. Maybe also what committees the organization has, who the committee chairs are. They might want to see their charters, the committee charters. Of course, list of employees with titles, job descriptions, wages, benefits, tenure. Of course, they'd want to look at any written employment agreements, because an employment agreement is an asset and a liability that it would want to assume. So if there's an agreement with a merged entity, that flows to the surviving entity. List of assets, of course, with market value, age, condition, repairs needed. If it's just a bunch of office equipment, that may not be necessary, but it's something that's often required. Copies of employee benefit plans. Again, those usually aren't assumed, but the surviving entity clearly would want to see what the employees of the merged entity have been given as benefits. List of debts, we've talked about that, and that would include the contracts. Often every single contract wants to be reviewed by the surviving entity, and at least the most important ones. For example, there may be a lease agreement, and maybe the parties have decided that the merged entity's office facility is better than their surviving entity. So if they're considering making use of that entity, or that entity's office, the merged entity's office, they're going to want to see the lease agreement. Also, the merged entity, although that is going to be going away as a separate entity, but it also wants to see many of the documents that I just described to know that it's the right thing to do for its membership and for its mission. You know, in order to do that, it takes a little bit more often than just speaking with the governing body or a few people from the other organization. You really need to take a hard look at all the documents. And a due diligence process is usually done through an electronic portal. It sounds difficult, but it's not. What may be difficult if you don't have a great organization scheme within your office or within your association of keeping all your contracts in one place, you may need to do a little work on the front end to get all those documents together. But otherwise, what happens, they're scanned, or they're actually just brought up into this portal, and then individuals from each of the organizations, and usually their lawyers and their CPAs and other consultants have access to it, and they can just pull up the documents and review on them. Gone are the days where you used to have to, fly to a town and sit in a big conference room and look through papers over and over and over. I spent a lot of time doing that in my younger days. But so that's the due diligence process. Again, very important in a merger. And then once again, reviewing the governance document and state formation statutes to determine requirements. That's very important. Much more important than affiliation transaction, because there will be requirements in the state statutes, and generally those are found if for instance, for the District of Columbia, it's a separate section in the nonprofit statute. Another jurisdiction may have it in a separate statute or a separate section. It may be part of the corporation at large section, which applies to all corporations, nonprofit or otherwise. But there's a section there that will talk about actual mergers. How does that have to happen? And you need to comply with those steps that are outlined in the state statute. One of the things that's always involved is a plan of merger. You will find a plan of merger in every single merger requirement for a nonprofit. And that's a document that will ultimately need to be approved by at least the board and maybe by the members. And you need to see what the state statute says, and you need to look at what your bylaws say. And your bylaws may be silent on that particular instance. I mean, sometimes nonprofit bylaws just say, the members of the organization need to approve maybe the budget, or they need to approve, maybe they need to approve a merger, but they probably never say they need to approve a plan of merger. So if the bylaws are silent, then you need to look to the state statute. I'll make one other point here that is important. If you have two separate state statutes in question, the documents may be labeled something differently. There's similarities from state statute to state statute, but the terminology sometimes is different. And some states have more stringent requirements. For example, if you're a New York nonprofit association, especially if you're a public charity, you have to either get consent from a court or from the Charities Bureau to actually have a merger. If it's a merger, it's usually pretty easy to get, but it's something, again, you have to think ahead of time about. So in addition to the NDA and the plan of merger we just talked about, often it's important to have an actual merger agreement. The plan of merger, which is the statutory required document, will list certain information that's required by statute. Often associations don't want to put in a bunch of other information about how these two entities are going to merge or operate in the surviving entity. What they do then is keep that in a separate document. Again, the plan of merger, which is required by the state, only has to list what the state says has to be in it. And that's usually, is there going to be a name change for the surviving entity? What's the new governance of the entity? what are the officers of this? What will the officers be of the surviving entity if they change at all? So that's what's in the plan. But a merger agreement would lay out all the other details, and that's why it's often a really good idea to have one. It could lay out, what's the process to merge the operations. There's a legal issue here with a merger, there's an accounting issue, but then there's the practical issue. How are you actually going to get your two associations to work together in order to continue providing the great programming that you've been providing to your members and new programming? You may want to discuss new programming in that merger agreement. You also want to discuss the employees, the status of employees in the surviving entity. Will all of them be moved over, or will the merged entity need to make some changes with that, with its employees before the actual merger takes place? That's something that you would have in the merger document. You would also want to discuss in the merger document how the C-suite's going to be, who's going to be in the C-suite, because in associations, if there's two mergers, there's usually two executive directors or two presidents, and you probably won't have two presidents for the long term. Maybe they'll co-presidents at the beginning, but there'll be some discussion of that in the merger agreement. Also, communication to members, again, talking about programming and governance, maybe in a little more detail that's required in a plan, because again, the plan of merger has to be filed with the state, such as other changes in the bylaws, or whether the committees will change and what the requirements of sitting on a committee will be. Those type of issues do not need to be disclosed to the state, but there are some things certainly that the two parties would want to talk about at the beginning, or during the process. So the plan of merger must be adopted by the board and maybe by the members. That's number 5 in the PowerPoint here in the slide. And we talked about the complications if your membership only meets once a year, maybe a little bit more complicated to get a member's approval. But what happens to actually close this merger? It's a transaction and there would be a closing, is the plan of merger and the consents are filed with the state. And also there's something called articles of merger. That's often just a one-pager that says Association A and Association B are merging and Association B is a surviving entity. It's usually just a one-page document. And also what would be required by most states is if the governing documents of the surviving entity have changed, they want to see copies of those. And then finally, similarly from the affiliation, the Form 990, the surviving entity, if it has changed its governing documents, and maybe it hasn't, it may be that the merged entity finds whatever the surviving entity has in place is absolutely acceptable. Its governing board and everything else in its governing documents. So maybe the surviving entity doesn't need to check the box in the Form 990, but the merged entity will have to check that it's their final Form 990. Marie, over to you.
All right, so jumping forward to the next slide and talking a little bit about the accounting. It gets a little bit complicated for us on the accounting side, because in this scenario of a simple merger where one entity folds up into a surviving entity, it has the appearance of dominance of that surviving entity and control over that entity that's going away, but that's not necessarily going to be the case. As we look at it from an accounting perspective, we delineate from a terminology perspective between a merger and an acquisition. And those terms for accounting are important for us to get to the right definition of the transaction, because it impacts the accounting method for how you bring those assets, liabilities, and so forth together in the financial statements of that surviving entity. So as we're looking at a merger, going back to that concept of control, we very much focus on control when we're speaking accounting terms. And for a merger, ceding of control by both entities is that sole definitive criterion. So both entities are giving up control. There isn't any dominant entity throughout the transaction or process. Now, certainly there could be indicators of dominance at some point along the way, and we'll talk about what those steps in the process that we focus in from an accounting perspective are, but we're looking at predominantly there's a coming together of organizations, two in this example, that are both giving up control, and that could still result in keeping the office facilities, as Kelly said, of the corporate entity that's going away, or the structure for the entity that's going away, but maintaining the structure of the entity that's surviving. And there could still be a coming together of those entities in a way that there isn't necessarily one more dominant over the other in coming to those decisions as to what that surviving entity will look like. And again, from an accounting perspective, that would be a merger. And if you do get to conclusion of a merger, that is the most straightforward approach to the accounting, in the sense that you don't have to determine fair values. So you're going to take the carrying values of assets, liabilities, etc., of each of the entities and bring them together on the transaction date for both of the entities going forward. So you don't have to do a look back and determine fair values, which can become more complicated. Now, as we look at the flip side of that in an acquisition, which could be the case as well in this example that we have, where one of the entities, presumably that surviving entity, it does dominate the process, and that entity that's folding up into the surviving entity is giving up control. So, again, it's the entity obtaining control over another entity is that sole focus that we have from an accounting perspective when we're defining what an acquisition is. And again, giving up control by both entities is our definition of a merger. And again, the accounting does matter. So as we look at the entities or the process, we're not looking for an individual point in this process, but rather the preponderance of indicators that would drive us to how control is being transitioned. Is it more of an equal giving up of control, or is there a dominance in that process? So acquisition, merger. So there's always a long process, at least as we see it on the accounting side, as to when discussions begin and are started and entertained between entities, and understanding whether or not there's that fit. The culture, the people, the programs, the mission, and all of the complexities and practical considerations that need to be taken into effect for this combination to be successful. As we look at that process from an accounting perspective, again, we're looking for dominance. Is there any indicators of one of the entities in the process dominating over that initial dance in the process? And we do look at the participants and kind of put them into a couple of categories, two primarily. As we're thinking of the accounting, we of course are thinking of financial capacity. We consider whether one of the entities is financially stronger than the other. Is one of the entities under some sort of financial difficulty or duress? And considering that, we would tick off whether or not we have an indicator that there's a likely ability for one of those entities to be more dominant. Obviously, the stronger financial organization, may be in a position of dominance in these negotiations in this coming together process. Or size, so that we could have two very strong, financially strong organizations, but one could be substantially larger than the other. And again, that could indicate that the larger organization has the ability to be more dominant in the transaction and in this process, Or conversely, we could have organizations that are both financially strong and of equal size, and that may be an indicator that we have more of a coming together of equals and not necessarily a dominance between one or the other. Again, looking for those indicators to kind of tick off our boxes and not look at anyone individually, but look at them collectively and together. So as we look at, as we set aside the finances, we then also focus on governance and any other indicators of power or control in the process, decision making. So in many of those documents that Kelly mentioned, the merger agreement or other documents that would describe decision making potentially, whether it's at a high level or at a more granular level, if as we're evaluating it, it's clear that one entity has veto power over another in that process or is dominating that decision making, that again would be more indicative of an acquisition versus a merger. But if perhaps they're creating an equal committee or decision-making body in that process with equal representation from each entity, that would likely be more indicative of a merger. You know, as we look at this process, we from an accounting perspective, we create that sort of checkbox and sort of a T. You know, this is indicative of an acquisition. This is indicative of a merger. We look at the pieces along the way. We step back and look at those indicators and the resulting entity structure, and try to then figure out and use professional judgment to determine what it is that we truly do have here. When we look at the acquisition process, and as I mentioned, from a merger perspective, you know, that carryover method is truly just taking the accounting at the date of the transaction from each of the entities of the assets, liabilities, net assets, including any donor imposed restrictions that may exist, and bringing those together into that combined entity. Whereas within the acquisition, we would be looking at fair value, and we would have to do a little bit more work to not just look at those listings of tangible assets that are included in the acquisition that dominant entity is taking on, but we would also look at whether or not there is any passing of consideration between the entities, or as a part of the transaction to a third entity, oftentimes in the way of a a donation to another nonprofit organization. So, you know, thinking of an example of what that might look like, the associations coming together, the acquiring entity may make a donation to a non-participant tax-exempt organization to support an aspect of programming that the non-dominant entity feels is very important, but won't continue in the surviving entity. So that's an example. So a scholarship fund, you know, something that you might want to consider. The surviving entity doesn't want to maintain that scholarship fund, but as part of that negotiation of the transaction, you know, something that we've seen on the accounting side is that donation going out. So when we record it on that surviving entity, we're looking at you know, a formula of, you know, the fair value of those identifiable assets that are being acquired, those liabilities that are being assumed, being measured again at fair value, and we're looking at the acquisition date, which Kelly defined for us as that time period or that point in time when everything is being filed with the respective states after everything's been approved and it's being officially filed. But we also do need to look at identifiable intangible assets. So thinking of that entity that's being acquired, do they have some sort of branded event that has intangible value of significance, some sort of publication perhaps that has some sort of intangible value that needs to be valued from an intangible value perspective. From an accounting perspective, we're looking at significance. So we really want to spend time focusing on identifying values for things that are significant. And then as we look at the end of that calculations, plus for assets, minus for liabilities, the differential and any consideration given being a subtraction as well, the differentiation or the difference is going to be an inherent contribution. So on the entity that is the acquirer, we would record a contribution for the difference so that transaction does balance out. Indicative of us in the tax exempt world where we're not necessarily always purchasing the assets and the net of the assets and liabilities in acquisition, but we may have that donation in play or that inherent contribution. I'm looking to see, we have a few questions up in the chat field. I don't know if, Kelly, there were any there that you wanted to tackle. I'm going to continue kind of scrolling down the content that I have here and just highlight just a few more things before we take a pause and see if there's any additional questions from anyone else in the audience.
For some reason, I can't see the chat questions, unfortunately.
Okay. One of the things just to highlight this is there are many costs that are incurred as the acquisition process continues on. And I don't know, Kelly, about you, but that process is generally one that's of a longer term nature. It isn't something that generally turns around in a month or 2 months. I think 9 months might be the fastest I've ever seen. I don't know. What are your thoughts on that?
9 months from the beginning to the actual closing of a merger.
Mm-hmm.
I think it all depends on the complexity of the two organizations, mm-hmm. and not only the complexity, but the due diligence process. Mm-hmm. Sometimes there's a lot of starts and stops. Mm-hmm. Sometimes they're really interested. Sometimes maybe the two parties aren't so much, or maybe one party isn't as interested. So it really all depends on how the two parties want to move the process. And also part of it has to do with due diligence. I mean, do the parties have their documents organized so it doesn't take months and months and months to get them uploaded? That would make a difference. There's very few things that should be from a state perspective that would hold back a merger or that would cause it to take 9 months. The only thing I can really think of is if one or the other of the merger parties aren't in good standing. So sometimes that takes a little bit of work to get them back in good standing, so there actually can be a legal merger. But it doesn't have to take 9 months. I think that's all.
Okay. So what I would share, however long that process does take, as we're looking at the accounting for the costs associated with it, those costs should be expensed as they're incurred by each of the entities. And then the other thing to consider is, when we're thinking of that inherent contribution coming into the acquirer, we have to look at, any donor imposed restrictions on net assets that are coming from the entity that's being acquired, as well as recognizing that donation is coming from the acquired entity and their governance group or executive management may, as part of the acquisition, create a donor imposed restriction themselves. So it could be coming from donors outside of the entity that's being acquired, or as part and parcel of that inherent contribution they're making to the surviving entity. They could be imposing donor restrictions. So an example of that could be that the pickup in net assets or that contribution for the surviving entity is designated for use in certain programmatic areas, or a portion of it is designated for use in certain programmatic areas. And from an accounting perspective, we watch those types of donor imposed restrictions closely and make sure that they're being tracked and reported on appropriately as to their existence, and then if they are something that can be satisfied as to their release in the periods that are appropriate.
That's also an issue with C3s that emerge if they have endowments. You know, some of them are restricted, and then you have to look very carefully at what the restrictions say before. And of course, any charitable funds, which those would be, can't be, of course, it can't be given to any form of any form of for-profit entity. But that's something that, again, with the due diligence process, you really need to work through. You need to look at what you have. Those are assets, and sometimes every asset isn't able to be transferred.
Mm-hmm, mm-hmm.
You have to think of another way to deal with it.
And as we look at that, that potential, public charity piece, the C3, the foundation that may be sort of attached and coming along for this transaction, if it is an acquisition, when we think of intangible assets, that donor list is not one that we would be looking to value from an accounting perspective. So that's everything I had. Kelly, did you have any additional sort of parting words or thoughts?
I do not. But thank you, everybody, for your time.
All right, thank you, everyone, and hopefully the information was helpful, informative. Kelly, I see you up on the screen, looking very much like your picture there with all of your contact information, and I think that must be a pre-COVID haircut for me on the screen there.
Same with me.
Yeah, but I'm not seeing my contact information popping up there, but Kelly certainly has it. If you're able to reach out to her if you have any of the accounting questions, I'd be more than happy to help out in way of follow-up. And we would just end with, from an accounting perspective, we very much need to drill into our accounting definitions of the terms that define the transaction that drive the accounting. Look forward to any assistance that I can provide to anyone.
Great. Thank you, Kelly and Marie. And thank you, everyone, for attending today's webinar, Upset and Reset Association Affiliations and Mergers. Please don't forget to fill out the forthcoming survey so we can better fulfill your needs. On behalf of Whiteford, Taylor and Preston and Clifton, Larson Allen, thank you for joining us today, and stay well.